Hello, I'm Steve Cress, Head of Quantitative Strategy at Seeking Alpha, and thank you for joining our presentation today. We're going with a header today, Keep Calm and Carry On, Top Stocks to Take on Trump Tariffs. Today is March 10th, and as you're seeing, you will find that March 10th was a big red letter day for the market. We have the S&P down significantly, the NASDAQ, the Dow Jones, all down significantly. So I couldn't think of a better time to actually do this presentation. I'm joined today with Francesca Friday. She is a quantitative strategy writer at Seeking Alpha. Little housekeeping to get out of the way first. We are not advising you personally concerning the nature, potential, value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, or strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by subsequent events. It represents my opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed securities dealer, broker, or U.S. investment advisor or investment bank. As always, thank you for your patience during that. As I mentioned, I'm Steve Cress. If you are new to Seeking Alpha, I have over 30 years of experience in the financial markets. The bulk of my career was spent at Morgan Stanley, where I ran a prop desk in quantitative strategies. I was there for about 13 years. I also worked at Northern Trust Asset Management. I was the founder of my own hedge fund, and I was also founder of the fintech company Cress Investment Research, which was purchased by Seeking Alpha 6 years ago. Thereafter, I integrated the quant system from Cress into Seeking Alpha's platform, and it has been a tremendous journey. That's a little bit about my background. Francesca, I was wondering if you could share a little bit about yourself.
Sure. Thanks for having me, Steve. I joined the Seeking Alpha team about 3 months ago from a place called Merger Market, where I was a senior private equity reporter. Before that, I spent about 7 years at the Financial Times covering different subjects across the financial world, including markets, mergers and acquisitions, and alternative investments.
Thank you so much for sharing that. So today, our presentation is going to cover why quant. We're going to provide a bit of an update on the tariffs and the sell-off in relation to the tariffs and top stocks to take on the tariffs at this time. So a little bit about quant and how we achieve our results. We do have a great track record, which I'm going to show you shortly, but I'd like to share a little bit about how quant operates. There are sort of a couple different lenses that we use. One lens with quant is that we use a strategy, and the strategy that we employ at Seeking Alpha is a GARP-oriented strategy, which is growth at a reasonable price. Underneath that, though, we really look for stocks with strong fundamentals, which isn't really any different than you would find from an analyst at Morgan Stanley, Goldman Sachs, or Merrill Lynch. Analysts at major Wall Street houses and most Wall Street houses tend to look at stocks with good fundamentals. At Seeking Alpha, we're looking for stocks that are collectively strong on growth, profitability, value, momentum, and positive EPS revisions. What separates us from the analysts at those major Wall Street houses is they tend to look at one stock at a time. And typically, an analyst will have a universe of maybe 15 to 20 stocks that they can cover overall. Outside of that, it's really hard to do it by hand manually. So most analysts will just have a limited amount of stocks in their universe. Conversely, at Seeking Alpha and our quant system, we have thousands and thousands of stocks where we provide a fresh opinion every single day. Every day we go through every stock's cash flow, income statement, balance sheets, and tons of financial metrics. And when we do this, we actually do it on a relative basis. So for each security, we compare it to other companies in the sector. Hence, using our quantitative model, looking at these fundamental factors and putting it through our computer processing, it gives us the ability to sort out the strong companies from the weak companies. And the companies that are strong, that have the best rankings, will get a strong buy. And it sort of falls in the order of strong buy, hold, sell, and strong sell. And again, that's refreshed every single day. So our vision uh, from the quant perspective is to really help investors eliminate emotional investing and uncover top stocks using data-driven tactics. We really, we don't personally talk to company management. We don't really find it useful with the process that we have since it is data driven. We're not really having discussions with analysts on Wall Street either. It's really all about the data. And, many investors, sometimes they'll inherit stocks or they'll get recommendations from friends that aren't data driven. There could be any number of reasons why somebody might recommend a stock where the data doesn't really back it up. With quant, it's strictly about the data and it's refreshing that data every day. So even if you compared it to a Wall Street report where that came out with a strong buy recommendation maybe 2 months ago or 3 months ago, for us, that would sort of be looking at a newspaper article from 3 months ago. It's really hard to make an investment decision based on something that is so outdated. Hence why when we make our decisions, we refresh that data every single day. So, how do we uncover the stocks that we have put forward today, since it is a very turbulent period and tariffs are on the horizon? What we decided to do was target defensive sectors. So we're analyzing non-cyclical sectors less impacted by economic downturns, such as consumer staples, healthcare, and utilities. That's sort of a broader look that I'm going to show you how to get. The stocks today have a little bit more of a protectionist factor to it as well. So we take Seeking Alpha's computer powerful model. And as I said, we sort all stocks. And when we look within these segments, we've identified stocks that we like. We research top quant ranked stocks and we select, as I mentioned, these top stocks using our strong buy system. So we have a pretty good track record overall. And I'm going to show you that track record. You can see going back to 2010 through 2025, we have significantly outperformed the S&P 500. Now, the way we judge this is taking a look at our quant strong buys, and we actually created a portfolio where every single day since 2010, we've loaded up the strong buy. So if the stock were to fall off that strong buy, it would come out of the portfolio. So this is just monitoring the performance of our strong buys. There's no cherry picking, but it includes every single one going back to 2010. And you can see if you put $10,000 into our quant strong buys, today it would be worth $300,000. Whereas if you put $10,000 into the S&P 500, it would be worth about 58,000. Now, I'm not showing you this because of any investment vehicle. We actually don't have an investment vehicle that you could purchase. There's not an ETF of our strong buys. The reason why I'm showing it to you is to really identify that the strategy, which is that GARP-oriented strategy, which I will say adds momentum and EPS revisions to the GARP, which is growth at a reasonable price. The strategy has worked really well going back to 2010. So that's really the point of why I want to show you that performance is more or less to identify that it does work with our strategy. Now, we can also say there are other things that have, a little bit more recent that help us. Quant, as you can see, helped me generate these articles. So you can see on January 10th, we put out an article, Best Defensive Stocks to Hedge Against Market Uncertainty. And then on January 27th, we put out another article, Feeling Bearish, Stock Up on These 5 Defensive Positions. And more recently in late February, we put out an article, How to Manage This Market in Essence, or Preparing for Turbulence was really the title. So some of the things that helped us pick up to this was early in January, we did notice a lot of the quant stocks that we cover, which were quant strong buys. And I have seen this historically. This is not only recently, I really have seen this, going back to sort of the crash that we experienced in 2007, experienced it when we had the pandemic. What I've noticed is that quant strong buy stocks start falling rapidly in unison. And to me, that's sort of like that Richter scale. We could see it going off before other things happen to the economy and the market. And that's sort of what exactly happened in early January. We began to see a number of our quant stocks acting strange, and it was doing it in unison. Hence why I wrote these articles. Now, of course, there were some other things that led off to that, and that's what was basically coming out of our economic environment, our geopolitical environment. As you probably recall, 2025 kicked off with the air of uncertainty as investors wanted to see how Donald Trump's economic agenda would impact inflation. So there was a lot of concern with that. And many individuals started voicing, that there could potentially be a bear market if we indeed had tariffs take place. And certainly we did see a lot of those fears erupt, fears with the tariffs sort of triggering an inflationary period, fears that inflation could stay stickier for longer, fears that interest rates would not come down and could actually go up. So there were a lot of fears that started coming out on January 10th that led us to write these articles, but it was definitely aided by seeing a number of quant strong buys starting to fall sharply, really well ahead of when the market started to come down. So here's sort of a recap of where we are as of Monday, today, March 10th. Wall Street stocks fell further today, deepening the recent sell-off triggered by investor fears over Trump's back and forth on tariff policies. So really, the market was quite strong. The economy was in good shape. We had full employment until the mention of these tariffs. And these tariffs have introduced basically a lot of fear and negative investor sentiment into the markets. Not saying that these tariffs won't work. I'm not sort of espousing any positive or negative standpoint. All I'm indicating really is that with the talk of tariffs, it creates uncertainty, and markets do not like uncertainty. And that's really the bottom line. Um, there could be a number of things that create uncertainty, and markets don't like it. Obviously, bull markets could be sustained, and sometimes when you're in bear markets, it becomes quite predictable, and you don't see big down days in bear markets. You just see negative days for over a long period of time. But volatility usually is accompanied by uncertainty, and that's certainly what we're seeing now because investors really aren't sure what to make out in a positive way or a negative way. What's going to come of these tariffs? So today, the S&P 500 fell further 3.2% in a single day after falling 3.1% last week. It was its worst weekly performance in 6 months. Today, the Nasdaq fell at 4.7% amid a big tech sell-off. It was weighed down mostly by Tesla, which was off about 15% today, but it was joined by Apple and Nvidia, which were down about 5%. Also, we had a number of major banks lowering their previously bullish forecast today. So all of this sort of helped account for the uncertainty that we saw in the market on Monday, March 10th, hence the major pullback that we've seen on top of the pullback that we saw last week. U.S. Treasuries today rallied on the back of this volatility, and the VIX index surged today as well, aka Wall Street's fear gauge reached 28, its highest level since mid-December. I will also say on the next slide, you can see the CNN Fear and Greed Index. It's an extreme fear territory at an index level of 16. This is the lowest level that we've seen on the Fear and Greed Index in 52 weeks. The Fear and Greed Index uses about 7 different indicators that are financial indicators commonly used in the market to show if the market is in a period of fear or greed, and they combine 7 of them together. Obviously, as we mentioned, Trump's tariffs and the conversations around these tariffs, highlighting that there will be tariffs, or the tariffs are pulled back, or the tariffs are reinstated. It all generates uncertainty, which the market doesn't like. Automakers, I will say, were granted a 1-month delay, which happened last week. Trump also said he will pause the 25% tariffs on Canada and Mexico that are covered under the 2020 trade agreement. So again, a lot of uncertainty, whether they're going forward with the tariffs or whether they're not going forward with the tariffs. It just creates that uncertainty that markets don't like, and that's where markets pull back, is during periods of uncertainty. Trump has also declined to rule out a recession, where that question was posed to him in the last few days. And this came after inflation data came out from the Atlanta Fed, which warned of an economic contraction in the first quarter of 2025. So the question was on the back of that data being released. So where does this position us with the sectors? So you could see over here, we list the GIC sectors, and you could see the 1-month performance is pretty dramatic for a 4-week period. You could see on the very bottom that consumer discretionary stocks have come off 8.83% in the last 4 weeks, and technology has come off 6% just in 4 weeks. Conversely, if you go back to the top, you'll see consumer staples are up 4.42%. Healthcare is up 1.95%. Real estate is up 1.19%. And just below that, you can see utilities are in negative territory of about 1%. In the last 5 days alone, consumer discretionary stocks in that sector have come off 4.76%. That's a big move for just a 5-day period. When you look at technology, down 3.1%, and consumer discretionary down 4.76%, that's a really big move for a 5-day period. So it really just indicates that the market and investors are rotating out of, most stocks, and they're sort of going for anything that is a defensive safe haven. And historically, those safe havens would be gold, cash, consumer staples, utilities, healthcare, and real estate. So really doesn't matter how strong the fundamentals are for any company right now. Doesn't really matter how good the results are. We've had many, many companies beating top line and bottom line analyst forecasts in the last couple of days, or really over the last 2 or 3 months. And regardless of those earnings and top line forecasts being good, most of those stocks have come off sharply. So it's clearly a market that's being driven by sentiment and fear and not fundamentals. So I will also say, if you can look at a couple other things, you can see how these are tied together. So here we show that investors are bullish on consumer staples. Polymarket is an online betting platform for future events, and it lets traders speculate whether Trump removes the Mexican tariffs before March, and sort of where they're voting along with that. This chart compares the probability to consumer staples sector, which you can see. So the consumer staples sector, which is the blue line, and the orange would be the U.S. imposing the Mexican tariffs before March 7th. You could see how that has moved up significantly from February 3rd to the end of February. And on the next page, you'll be able to see how the trade war woes contribute to more potential Fed rate cuts. Now, this is really interesting because at one point, if we went back to September, October, and November of last year, the market, it was pretty promising that inflation was going to continue to come down in 2025, and that the market was looking for as many as 3 or 4 rate cuts in 2025. Then when we got to a period after the election and we got into December, when the talk of tariffs started coming, the interest rate traders were basically voting that there would be less interest rate cuts, and many were speculating that there would be no interest rate cuts. Now we're getting to a point where a lot of interest rate traders are actually fearful because of the tariffs and the negative impact that it could have on the economy. Despite it being inflationary, the fear is that it could be actually induce a recession where growth would slow down. So there potentially could be, in that environment, if there's a slowdown, that Fed rate cuts. So when you're looking at this chart, according to bettors, a betting market anticipates that the U.S. imposing Mexican tariffs, the financial markets have priced in more Fed rate cuts for 2025. So it just shows you how all over the place the markets are based on what's going on. And again, it comes all back to uncertainty, uncertainty, what's going to happen with inflation, what's going to happen with interest rates, and what's going to happen with tariffs and potential trade wars. And the market does not like uncertainty, and that's why it is off so significantly. And that's why so many stocks with great fundamentals are off a lot too. These were some of the high momentum stocks of 2024 and 2025, which have just gotten routed over the last couple of weeks. And again, it's attributed to people taking capital out of those stocks and rotating into the safe havens. So without further ado, I want to take you to a couple stocks that we think should do well here. The dust may settle in the next couple of days. It may settle in the next couple of months. Either way, these stocks have good fundamentals, and there's a bit of resiliency to them. So we have 3 stocks that we're highlighting today. OppFi, which is a financial company. We have Brinker, which is ticker symbol EAT. And we have Pilgrim's Pride, which is ticker symbol PPC. You can see most of them have really excellent value grades, great growth grades. Most of them have really good profitability, with the exception of OppFi. But they've had tremendous growth at that company. And you can see analysts like these companies by the EPS revision grade. That is a proprietary grade to Seeking Alpha. And it actually is a grade that shows you the number of analysts that are moving estimates up compared to how many are moving it down versus the sector that those stocks are in. So if you look at the 1-year performance or the year-to-date performance, you'll see it's up compared to the market. The 1-year performance for most of these stocks have completely crushed the 1-year return for the S&P 500. However, if you look to the far right side, you'll see the 1-month performance. And many of these stocks, despite their strong growth and their excellent valuation frameworks, have gotten hit pretty hard. So we have OppFi is down 43% in the last 4 weeks, and Brinker is down 17% in the last 4 weeks. Pilgrim's Pride, which is like a true and tried consumer staple stock, is the only one that is up over the last 4 weeks. Having said that, all the companies really have great valuation frameworks. All of them beat estimates recently when they reported their result. So they look good on a top line and a bottom line basis. And most of them do offer somewhat protectionist features, which we'll get into. And Francesca, since you help uncover these stocks, I'm going to let you tell us a little bit about them. Thank you.
Thanks, Steve. And like Steve said, these strong buy ratings are like the Richter scale comparison, just an indicator of how strong these fundamentals are and how these stocks are still surviving considering the market that we're in. So first of all, Pilgrim's Pride, we have a market cap of 12.95 billion. It's in the consumer staples sector, number 3 out of 183. And it's in the packaged food and meats industry, also right at the top, 1 out of 54. What is Pilgrim's Pride? It is one of the largest chicken producers in the US. It invests one of the big things that stuck out to us when we were filtering for these stocks is the fact that it is currently investing heavily in a plant in Mexico. So during their latest earnings call, the CEO, Fabio Sandri, said he doesn't expect any important reduction in trade volumes, but if they do occur under tariffs, he said that PPC will have the benefit of having its operation in Mexico. So there's a little bit of a hedge for us. And that is something that sticks out compared to their competitors. The fact that they have operations on the ground in Mexico could be a major advantage there. So diving into the quant metrics a little further, they have near perfect trailing and forward PEGs, that's price to earning growth ratios of 0.05 and 0.2 respectively. Whenever you have a PEG under 1, that typically indicates that a stock is undervalued compared to its peers and comes at a great discount. So a little bit on the growth, forward gap PE of 10.8 comes out a negative 41.9% difference versus the sector median. That indicates both an attractive valuation and the fact that the company is in a great, healthy cash position. Also, forward EPS diluted growth of 39% comes out of 477% difference to the sector median. And then you have forward free cash flow per share growth of 61%, which is a 919% difference. So still great growth metrics, despite the fact that markets are getting hammered right now.
And on to our next stock.
So next up, we have Eat Brinker International. Now, if you're not familiar with the company name, you might be familiar with their restaurants. Chili's is probably the biggest one. They also own Maggiano's Little Italy, an Italian chain across the US. So they have a market cap of 6.3 billion. It's in the consumer discretionary sector, number 2 out of 482, and it is the top ranked quant restaurant, 1 out of 83. So really impressive in the current market. It's rallied 185.5% over the past year. And if you look at its most recent quarterly results, they were its highest ever. And that is because of higher foot traffic to their restaurants. They introduced a lot of new menu items, particularly at Chili's, which is doing a lot to appeal to budget-conscious diners, especially in today's economy. And they've done a lot on social media, so their items are all over the internet, and it's bringing in a ton of new customers, and that is really showing in the margins. They lowered their food costs in Q2, which is a really difficult thing to do when you're in the restaurant business, given inflation, thanks to all that increased sales growth that came from some of the things I just mentioned. So diving into the quant metrics, they have an A-rated PEG of 0.45. That comes at a negative 67% difference from the 1.37 sector median. So really great bang for your buck compared to some of the other stocks out there right now. Looking at growth, they have a forward EPS gap growth of 60.6%, which is a whole 663% difference. The quant metrics can be really helpful in painting just how ahead of the curve they are in some of those categories. And if you look at EPS revisions, you have 20 positive revisions from analysts over the past 90 days and zero negative, which, if you take a further look into our quant system, you'll quickly realize that 20 is a lot. And that is a very promising picture considering how difficult the restaurant business is these days.
I would say that analysts look very positive on this stock, so that is really supportive and really helps to validate what we're bringing forward here.
Definitely.
And on our next company, a little bit more controversial because it's come down so much in the last 4 weeks, despite being, having such a tremendous rally. So if you could tell us about OppFi, that would be fantastic.
Sure. So OppFi is a little more mid cap than the first two. It is 832 million. It's in the financial sector, which, is not exactly one of the leading, non-cyclical sectors right now, but because it's in consumer finance, ranked 1 out of 39, that actually places it in a more advantageous position. So looking at some of the metrics, it has an A plus forward PE of 6.48. That's a negative 41% difference versus the 11x sector median. So really great PE there. It's leveraging AI powered underwriting to partner with local banks on short term loans. The high yield credit space is one of those niche corners of finance that actually does well in a market downturn. So it is very much ahead of the curve compared to some of its fintech and financial competitors. And given that there could be looser regulation in the financial sector under the Trump administration, that's one of the big promises that his campaign ran on. The financial sector is a bit more insulated from tariffs than other sectors. So if you look at the 3-month price performance, you can see excellent momentum of 32.4% versus the negative 8.6% sector median. So it's really overperforming compared to a lot of its peers. And just an interesting growth tidbit, if you look at the forward EBIT growth, it's 66%, which is an impressive 606% difference versus the sector median.
Yeah, I think in terms of financial companies, taking the view that they're, the debt that they're involved in is so short-term oriented versus like long-term mortgages or commercial
Exactly.
loans, it's almost like a, treasury bill effect compared to like long-term bonds. And I think that short-term nature definitely makes it more attractive.
Absolutely.
All right. So, obviously a lot going on with how we select these stocks with our quant system, with the algo that we have using our model, with the strong buy recommendations, with comparing it to other companies in the sector. For a lot of people, that is just a bit too much work. So this is the feedback that we had over the last couple of years, and on the back of that feedback, about a little over 2 years ago, I created a product called Alpha Picks. So here we actually do the research for people, and we really designed this product for long-term investors. So I want to tell you a little bit about it. It is a quant product where we focus on our best quant strong buys, but only 2 quant strong buys every month. So for individuals that are looking for just a few ideas for the long term, we thought that this advisory product we created would really hit the spot, and it has done quite well. Since its inception, going back to July of 2022, it is up 128% versus the S&P, up 52% for the same period. And here, the quant team, as I mentioned, every month on the trading date closest to the first of the month and the 15th of the month, we send out what our favorite quant strong buys are. It goes out via email, but we also have a separate Alpha Picks platform where you can go to that as well to get the articles. And we have saved every article since inception. So it's very, very transparent. We also showcase the performance on the AlphaPix platform, the rating, the date that the purchase was recommended, what the share price was. So every single stock that we recommend is very, very transparent. And even in terms of the performance of the overall portfolio, we show what the weighting of the stock is to really bring forward that transparency. Again, just a couple of things about it. It is a little bit different than the overall quant system. And as a result, as I mentioned, it's on a different platform because we're trying to keep it simple by just having those 2 ideas out there a month. The model is a little bit different in that the stocks that we recommend other than being a quant strong buy. They also have to have a market cap over 500 million. They have to have daily dollar average volumes greater than $10 million. We also, for this particular product, we don't recommend REITs. REITs are very different to analyze, so we don't include it in this product. And this is also focused primarily on stocks in the United States or ADRs that are primarily listed in the United States. So there are additional criteria that make it a little bit different. So it's not like just you're going to the Seeking Alpha platform, taking a look at the screener and looked at the top ranked stocks. So it's important to know that there's different parameters and criteria when we recommend the alpha picks, but it's had great performance. So if you feel like it's a little bit overwhelming looking at the entire Seeking Alpha platform, or you just want really good recommendations on top of the platform, Alpha Picks could be a good product for you. So that brings us to our Q&A, Francesca. I know you went through a couple of the questions in our recent article. Perhaps you could bring those forward and answer them.
Yeah, we had a couple of questions that popped up a number of times that I just thought would be relevant for the audience as a whole to take a look at. So we had a reader called Saint Mark write in, does PPC export to Mexico, Canada, or China? And separately, does Brinker International have restaurants in those countries? Tariffs will cut both ways. And I think a big theme of this is that no company is fully insulated from tariffs, and that's not what we're trying to say with these picks. But these companies do have really strong underlying fundamentals that make them particularly resilient. Now, if you're looking at PPC, Mexico is their biggest trading partner. But something we mentioned earlier in the presentation, they're investing heavily in a new poultry farm in the Merida region in Mexico. So they have boots on the ground there. And the CEO is very confident that their multinational structure is actually going to put them at an advantage in a tariff situation, instead of some of their competitors, which have to export everything from the United States. They do have smaller exports to China and no exports to Canada. And looking at Brinker, does Eat have restaurants in those countries? They do have operations in Canada and Mexico, none in China, but the majority of their restaurants are in the US. And the products that they use to cook the food and maintain the restaurants are all coming in from their countries of origin. Next, we had a reader called Higher High write in. Is it true that our restaurants won't be impacted by tariffs? I wouldn't want to buy any restaurant stock because if we go into a recession, who will be eating out? Jim Cramer insists that everyone should buy Texas Roadhouse, but every stock I have bought, which he thinks is great, is way down. That is why the only thing I can really trust is written by Stephen Cress. Now, we're
Well,
not claiming that, everything we write here is going to be 100% correct every time, but Steve, maybe you could show the comparison of Texas Roadhouse in our quant
yeah,
system.
absolutely. And I appreciate the compliment. But I could show you basically how to do this yourself. You don't have to take Steve Kress's word. You don't have to take Jim Cramer's word. You can actually do this self. So I'm going to take you to the Seeking Alpha platform, and I'm going to show you two things. First thing, we'll start with, we're going to show Brinker, which is what we're recommending in this article today. And it's significantly outperforming the market at the close of the day. It's only down about 1%. The market, since this is live on March 10th, I'm actually going to show you where the markets were. At the end of the day, Dow Jones was down about 2%, the S&P down about 2.7%, and the NASDAQ down about 4%. I would say each of these indexes did come off their lows. At one point, the NASDAQ was down almost 5%. So each of those indexes well off their lows. But taking a look at Brinker, ticker symbol EAT, you can see why we like the stock so much. If you look on the right-hand side, you can look at the factor grades, excellent valuation framework, B. Really, everything else is almost A pluses. Growth is an A plus. And again, this is sector relative. So when we're looking at this, it's compared to the consumer discretionary sector. So growth is much stronger than the sector. Profitability is much stronger than the sector. Momentum is much stronger than the sector. And analyst revisions are far stronger than the sector. So I'm going to click on two things here to show you. It's really within one click. If we click on growth, this will show you all the underlying metrics that make up the overall A plus grade that we have for growth. So you could see their revenue growth year over year was 13% compared to the sector at 2.8%. So you can see how that grade kind of gives you an instant characterization of the strength or weakness of that particular metric. So revenue growth at 13%, a huge premium to the sector, which is at 2.84%. If we scroll down and we look at the bottom line numbers, if we take EPS gap growth, the EPS forward growth rate for the company is 60% for Brinker. That is huge. They are doing just a fantastic job. The consumer discretionary sector only has forward EPS growth of 7.94%. So Brinker at 60% growth is literally at a 663% premium to the sector's growth. So you can see why we like this company so much on growth. And on the valuation framework, which is a B, you will see a couple of C's, but my favorite, which Francesca mentioned earlier, which is the PEG ratio. PEG on a forward basis is an A grade. It's 0.45 times versus the sector at 1.37 times. So it's at a huge discount on a valuation basis to the sector, a 67% discount. And that helps to bring up the overall grade. So I will say our underlying metrics are not equal weighted. We have back tested all of these, and some are more predictive than others. Hence, you could see, obviously, PEG bringing up the rest of the grade has a little bit more weight than the others. But you can see the overall valuations. That really, if you look at it on a PE basis, it's a C plus. It's at 16 times versus the sector at 15 times. So it's just a little bit expensive on that conventional metric. But the PEG, it's a huge, huge discount to the sector. So let's go to back to the summary, and we're going to put in Texas Roadhouse. Ticker symbol TXRH. So here we're going to be able to make the comparison. The valuation on Texas Roadhouse is an F. So you can see the valuation was actually much more attractive for Brinker than it is for Texas Roadhouse. And actually, what we could do is we can click on something that shows peers. And this will actually show you other companies that are within the sector, and you can edit this. So I'm actually going to edit this so I can make a comparison just between the two. So I'm going to take out Domino's, I'm going to take out Armach, Luckin Coffee, Kava, and Dutch Brothers. And I'm going to put in EAT and bring up Brinker, hit compare. And as we scroll down, you can see on a 1-year basis, Brinker is up 191% versus Texas Roadhouse up 20%. So it's been far stronger on a 52-week basis. As we scroll down, you can see the quant rating for Brinker is a strong buy. Our CK Alpha contributors, their consensus is a hold on the stock, and Wall Street consensus is a hold. I will say I think the quant has definitely outperformed both the contributors from CK Alpha and certainly Wall Street here. It's the reverse for Brinker, where the quant is a hold, but the consensus by both our contributors and Wall Street is a buy. So from that qualitative element, they're seeing some positive aspects to Texas Roadhouse, as probably Jim Cramer was saying. But from a data-driven basis, we're really seeing it for Brinker. And fortunately, we could see, looking back over the last year, Quant has nailed it with Brinker and its rating because the stock has done really fantastic. When we look at it just from a data-driven basis and we rank each stock within the industry, Brinker ranks 1 out of 43, and Texas Roadhouse ranks 23 out of 43. Again, that valuation grade of F bringing Texas Roadhouse down because it's very expensive compared to the sector, where Brinker with a B grade is got an attractive valuation framework. Then as we sort of scroll down to some other areas, we could see Texas Roadhouse actually has a dividend, which our quant system would view as a very poor grade, D+. Historically, the safest grades are from B- to A+ for a dividend safety grade. If you get below a B-, typically there are indicators that have not back tested well, so that would serve as a warning sign. On a valuation framework, just a traditional value PE, Texas Roadhouse at 25 times versus Brinker at 16 times. So Brinker is definitely a lot cheaper. And then when we look at the growth, the year-over-year growth rate for Texas Roadhouse is a bit stronger at 16%. Again, this is the year-over-year. And the forward growth rate on a revenue basis is a little bit stronger for Texas Roadhouse as well. But when we get down to the bottom line, this is where we see a huge difference. EPS, the bottom line for Texas Roadhouse, is growing at 19% versus Brinker, which is growing at close to 50%. So the bottom line shows you that Brinker is bringing in a lot more money than Texas Roadhouse is. So this is a great way that you can make that comparison yourself. You don't really need Steve Kress or Jim Cramer to do it. You could just go to the quant system. It's data driven. This isn't data that we generate. All the historical data that you see, it goes from the SEC to Standard and Poor's. All the forward data that we utilize in our model is the consensus from Wall Street analysts and their earnings estimates. Another thing that you can do, instead of relying on looking at the articles or listening to the webinars, you could actually run those stock screeners yourself. And I think this is really important. As I did mention during the presentation today, the market is really in a very defensive mode. There's a lot of uncertainty. And historically, when you're in uncertain periods, you want to look to consumer staples, you want to look to utilities, you want to look to REITs. So we have some preset screens. So if you go to the stock screener, which is on the left-hand menu here, towards the bottom, you'll see stock screener. Then you can sort of just screen down and you'll see top consumer staple stocks. So you can actually pick the stocks that you like. And once I click on that, you can see there's a number of companies that have a strong buy that are consumer staples. We have United Natural Foods, Pilgrim Pride, which we recommended today. Clorox Company, very great, strong company for this environment. Reckitt Benckiser is an international company based out of Europe. We have Mission Produce, which big in the avocado business. So they have to deal with tariffs, but they've had a good way of counteracting that. Tyson Food. So a number of companies with strong buys that you can take a look at yourself. Likewise, you can check out the utility sector. So if I want, I could go into stock screener again. And I'm just going to scroll to the bottom. A lot of these screens I've actually made myself. So you'll see on the right-hand side where it says create new screen. You can create all kinds of screens yourself, but Seeking Alpha has provided some pre-baked screens that you'll find under Seeking Alpha screens. So if I want to go to utilities, I could just go top utility stocks. And you can find a number of strong buys and buy recommendations within utilities. So I'm going to take us back to our presentation. And I really think that is sort of it. This is sort of just a screen that showed those top stocks in the consumer staple sector, but I showed you how to do it on the platform yourself to find a number of those names. So based on our webinar today, we pulled out a couple names, OppFi on the financial side, Brinker, ticker symbol EAT, and Pilgrim's Pride, ticker symbol PPC. But there are a lot of stocks that you can check out yourself on the Seeking Alpha platform. Or again, if it's a lot of work, we have a separate product, which is Alpha Picks, where the quant team picks the best strong buys for you twice a month. And that really concludes our presentation on behalf of Seeking Alpha. Thank you so much for your time today. Again, really just stay calm. Keep looking at stocks with good fundamentals. Try to ignore what's happening in the markets. Try to ignore the talking heads. At the end of the day, what will serve you best is staying disciplined and month in, month out, just try to find stocks with good fundamentals and keep plugging away at it. And your performance will be good. Thank you very much.
Thank you.